Good morning, everyone. I am Tahsin Sultana, Assistant Professor, Department of Commerce, Government First Grade College, Presetom. In this session, I will be discussing derivatives under this options, futures, forwards, and warrants. Learning objective is to provide overview of security analysis. Outcome of this session, students will be able to understand the basic derivatives and their valuation. Let us begin this session with the meaning of derivatives. A derivative can be defined as a financial instrument whose value depends on or derives from the value of an underlying security. So you may have questions: what is derived? Value or price is derived. From what it is derived? It is derived from the underlying asset or underlying security. These are the examples of underlying assets or security. A financial claim can be an underlying asset. Debentures or bonds, exchange traded funds, market index, currency, and commodities can be underlying securities or assets. Let us take an example of commodity derivatives, wheat derivatives. Under wheat derivatives, the underlying asset will be wheat. If the price of wheat increases, the value of wheat derivative will also increase. If the price of wheat decreases, the value of wheat derivative will also decrease. So, the value of derivatives completely depends upon its underlying asset's value. In this example, it is wheat. Let us take one more example in commodity derivatives, crude oil derivatives. Under crude oil derivatives, the underlying asset will be crude oil. If the price of crude oil increases, the value of crude oil derivatives will also increase. If the price of crude oil decreases, the value of crude oil derivatives will also decrease. So, the value of derivatives depends upon its underlying assets or security. Next, why derivatives? Are for hedging. Derivatives are for speculation and it enhances liquidity. What is hedging? Hedging refers to taking a position to control, avoid, shift different types of risk. This is very useful in highly volatile market. The traders protect themselves from adverse price movements. Let us take an example and understand this. Assume there is a farmer who is expecting to produce 500 tons of cotton in next 6 months. He could set a price for that quantity and quality by selling 5 cotton futures, each being of 100 tons. In this way, the farmer is fixing the price today for the crop of cotton which will be harvested after 6 months in future. So the farmer with this derivative is hedging the risk. Speculation. The primary object of speculation is to make profit. So let us take another example. Let us assume I am holding a company's shares value of 20,000 rupees. Now I expect that company's shares value to fall in the next month. So what will be my action first? I will sell off these shares and will gain 20,000 rupees. Will wait for the downfall and again I'll buy those company shares for 15,000 rupees next month. So in this process, I will be gaining 5,000 rupees. That is called speculation. I am taking a position to gain the profit. That is called speculation. Enhance liquidity. Enhanced liquidity refers to here in derivative transaction, no full amount of transaction is required. Most of them are on margin trading. Let us go and understand the first future contract. The meaning of future contract is a standardized contract between two parties to exchange a specified asset of standardized quantity and quality for a price agreed today with delivery occurring at a specified future date. So what we have understood from this meaning is futures is a contract or agreement between two parties. It means that there must be a contract binding on the parties and same should be fulfilled on some future date and for some agreed price. These are standardized contracts and are traded on organized future exchanges. Margin money has to be deposited, which is compulsory. Buyer and seller enter into future contracts to hedge against the price fluctuations. The types of future contracts are commodity futures, financial futures, equity and stock index futures. These are certain terms which you must know to understand the concept of future contracts. Contract size, the amount of the asset that has to be delivered, and under one contract here there will be lot size. Lots refers to the minimum quantity that one have to buy to complete a contract. See, for example, here I have given example of Tata Steel 500 shares. This 500 shares is called lot. So the contract size of one future contract will be this 500 shares multiplied by the share value, face value 100 per share. 500 shares multiplied by 100 per share will make one future contract. This is called contract size. Contract cycle, the period for which a contract trades. The futures on the NSE have 1 month, 2 months, 3 months. 1 month is called near month. For example, if the contract is for 3 months period. So, let us take from January to March. January will be called as 1 month, Feb will be called as next month, and March will be called as the far month. Strike price, the agreed price of the deal is called the strike price. Cost of carry, difference between strike price and the current price. A margin is the amount of money that must be deposited to open a future contract. Initial margin is nothing but the starting amount, initial token amount which has to be paid. It will be usually 10% of the contract size. Let us take an example and try to understand these future contracts. We are buying a Tata Steel future contract and we have entered into this contract in the month of September. The current price is 130 per share and we are expecting it to go to 140. So the strike price is going to be 140. Now the contract size is going to be 500 shares. This is the lot multiplied by 130, 65,000. Now in October, so the price will go up to 140. This is the strike price. So 500 shares lot into 140, 70,000. So now you may have in your mind a question that whether the seller will exercise the contract. Definitely seller has to exercise this contract. Seller has to complete this contract because it is obligatory in future contracts. He cannot go behind. So they have entered into a contract. It is obligatory on both the parties. Here we are buying a contract, so the seller has to exercise this contract now. So in the month of October, it has become 140. So here the price will be 500 shares into 140 per share, 70,000. What is our profit share? It is 140 minus 130, 10 rupees into 500 shares, 5,000 rupees we are gaining from this future contract. Problem on valuation of future contract. This is the formula which we are going to use. F0 is equal to price of the future contract, S0 spot price of the underlying asset, RF risk-free rate of interest, N life of the future contract, D expected rate of dividend. Let us take this problem. The share of Vikas Limited is currently selling at 300 rupees. This is S0 spot price. The risk-free rate of interest is 1% per month. This is RF. What will be the value of 3 months? This is N. So formula S0 300 1 plus RF is 1%, 0.1, n is 3 to the power 3. So 1 plus 0.1, 1.1, multiply this 3 times, 1.1 into 1.1 into 1.1. With that answer, you multiply 300, you get rupees 306 valuation of this future contract. The next derivative is options. Options meaning is contract that give the holder the option to buy or sell specified quantity of underlying asset at a particular price on or before a specified time. So what we have understood from this, it is option. Option means that the holder has the right but not the obligation to buy or sell underlying asset. It is a contract between two parties where one gives the other the right to buy or sell an underlying asset at a specified price and time. Option provides better scope for risk coverage. So let us understand this by taking an example. Cipla Private Limited 1000 shares. Current market price of those shares is 2000 per share in October. So we are entering into a call option. So we are buyers. We are going to buy this. We are expecting the price to go up to 2200 per share. So we have entered into a option contract by paying 2% of premium amount, token amount, okay, to book the contract. Now the price goes up to 2200 in the month of October. Are we going to exercise this contract? Definitely we are going to exercise this option. Why? Because we will be gaining 200 rupees per share from this contract, option contract. Okay. So is the buyer going to complete this? Yes, buyer has to obey this contract, and whenever the buyer is exercising this contract, it is obligatory on the part of the seller to complete the contract. Okay, so there is one more chance that in the month of October it may go down also. From 2000 per share, it may go down to 1800 also. If it goes down to 1800, here we will be losing 200. The question is, are we going to exercise this contract? Answer is no. Why? If we exercise this contract, we will be losing 200 rupees per share. So what the seller will do? Seller will also lose, right? But here the seller will gain the amount which we have paid as premium, 2% of the contract size, right? So what is the loss for the buyer here? Buyer will lose the amount which he has paid as advance in the form of premium to book the contract. Okay. So this is the example to understand option contract. Types of option contracts: American option, European option, call option and put option. What is American option? In this option contract, if the option is exercised at any time between the writing of the contract and its expiration is called American options. European options, if the option is exercised only at the time of expiration, is called European options. Call options give the buyer the right to buy an underlying asset on or before specified date. Put option gives the buyer the right but no obligation to sell a given quantity of the underlying asset at a given price on or before a particular date by paying premium. There are certain terms which you must know to understand this option contract clearly. Underlying will be specific security or asset. Option premium, price paid in advance to book the option contract. As in the previous example I told you, it will be 2% of the contract price. Strike price, the price at which we are fixing the contract. Expiration date, date on which option expires. Exercise date on which it will be exercised. Option holder, one who holds the buying option. Option writer, one who sells option. Exchange trade is exchange traded and OTC options. ITM, ATM and OTM, these terms we will be able to understand in the next problem. So this is the problem. State whether each one of the following is in ITM, ATM or OTM. ITM refers to in the time money, which means the contract is advantageous to exercise. ATM refers to at the money when the market price is equal to exercise price. It is useless to exercise the contract. OTM is nothing but out the money when the contract is not advantageous to exercise. Now call option, market price is given, exercise price is given. Again call option, market price, exercise price. For put option, market price, exercise price. Put option, market price and exercise price. Put option, market price and exercise price. Call, market price and exercise price. So by seeing these prices, we have to judge whether it is ITM, ATM or OTM. First call option, market price is 50, exercise price is 50. Both are same. So here it will be ATM because at the money it is not advantageous to exercise the option. It is useless. Both the prices are same. Now again call option 330 and 350. Here market price is less than the exercise price, OTM, out the money. So it is not advantageous to exercise the option. Put option, market price is 400 and exercise price is 450. So here market price is less than the exercise price. It is advantageous to exercise the contract. Put option 200 market price and 180 exercise price. So market price is greater than the exercise price. It is OTM, out the money. It is not advantageous to exercise the option. Put option, market price is 100 and exercise price is 120. Market price is less than the exercise price. It is ITM. It is advantageous to exercise this contract. Call option, market price is 60, exercise price is 80 and market price is less than the exercise price. It is OTM. It is not advantageous to exercise this option. The difference between futures and option. Future need to be honored. The agreement and buy and sell shares at a predetermined future date. Options allow the investors to buy or sell shares at a predetermined price before the end of the contract. Futures next point is hold high amount of risk. Options hold risk limited to the premium paid by the investors. Buyers are obligated to abide by the contract in futures. Here in options there is no obligation. Sellers are obligated to sell at the decided price on the decided date. In options, seller has to abide by the buyer's purchase decision. Investors only have to pay the commission rate. Here in option, a certain amount of the total sum is paid as a premium in advance, that is to book the option contract. Here in futures, both gains and losses can be unlimited, but here in option, gains are unlimited and losses are limited. Shares need to be bought and sold at a predefined date in futures. Transactions can happen any time before the contract expires in options. Next derivative is forward contract. A forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. These are simple customized contracts between two parties to buy and sell an asset at a certain time in future for a certain price. These are also known as forward commitments. These are not traded on exchanges, rather traded on OTC. They are not standardized contracts. They are privately arranged agreements. They are traded on OTC. These are customized contracts. These are unique in terms of contract size, expiration date, asset type, and quality. Next derivatives are warrants. A warrant is a bearer document of title to buy a specified number of equity shares at a specified price. A warrant is a bearer document of title to buy a specified number of equity shares at a specified price. These are used to make preferred stock bonds attractive. Bonds will have low interest rate, but warrants offered along with them will help the investor enjoy the equity appreciation value, and also it will reduce the cost of debt. Thank you.